All right, everyone. Good morning. Welcome to our Vectorvest International Online Forum. No, your eyes do not deceive you. I am not Stan Heller. My name is Jerry D'Ambrosio. I'm happy to fill in for Stan today. Stan will be in the background if you guys have any questions, but Stan is just coming back from vacation, so we had scheduled myself and Jim Penna to conduct today's session, and we just said, you know what, Stan's just getting back, so we're going to go with it. So I do want to welcome everybody. Again, it is 11 a.m. here on the East Coast. I do have Mr. Jim Penna, a good buddy of mine and colleague, manager of retirement services with Vectorvest. He and I will be teaming today, and he's got a nice presentation coming up here in about 45 minutes on just some of the basic building blocks on how to use options, to profit in the stock market. And we'll talk a little bit about Angela Akers' essay, which she does talk a little bit about options, and just take you guys through, the normal routine of going through all of our markets, the status of all of our color guards, and just, relaying our guidance to everybody out there. Let's see. Hey, Tom is joining us. Hey, Tom, how you doing? Regine, John, Mark, I see a lot of comments coming in here. Keep them coming, guys. Don't forget to hit that like button if you guys don't mind. We have Joey Rodriguez in the background. He's producing the show today. Again, Stan Heller and Ray Clark will be in the background if you guys have any questions. And I'll, of course, keep an eye on the chat box if you guys have any along the way. I am required to just leave this screen up here a little bit, just a little disclaimer, just talking about, what we're going to provide to you guys here today. Let's start with the agenda. I'm going to finish up in a moment here, the welcome and the purpose of our meeting. Again, the purpose of our session today is just to keep all of our subscribers, everybody up to speed globally on the status of your market, right? So if you're in Canada, anywhere in Europe, the UK, Australia, and of course here in the States, today's a good day, finishing the week, starting the weekend, getting ready for the next trading week, to understand what the Vectorvest guidance is and, how to take advantage of the current market, no matter which market you're trading. So that's the purpose of our session here today. What I'll be doing to kick things off is it might be a little bit longer than a 20-minute global market forecast. Just again, taking a look at the different color guards and market timing graphs, maybe seeing something on a market timing graph that I would like to relay to you guys. There are a couple of patterns, excuse me, particularly in the US and Canada, that I will point out once we get into a market timing graph. But once I'm finished there, Jim's going to do a special presentation called an introduction to options trading. So just going to go through the basic building blocks of any option trades. There are a number of different option trades out there that you can utilize in any type of market environment. They all revolve, though, around buying and selling calls and puts. And that's what Jim is going to do a great job laying out for us here today. Okay, we will adjourn at 12:30. The recording will be available on YouTube immediately after the webinar, same location on the Vectorvest YouTube channel. The slides will send you an email on Monday afternoon that will have a link to today's slides. So just check your email folder. They might wind up in your junk or your spam folder, but just check your email Monday afternoon, for the slides that we use today. Okay, everybody ready to go? Any questions before we start? Again, I really want to thank Stan for being here and allowing Jim and I to kind of fill in for him today. We got some pretty big shoes to fill. He does such a great job with these every Saturday. But we're really, really glad to be here. All right, looks like no questions are coming in, and we'll continue. So we'll start with Angela Akers' essay this past Friday. She titled it "Make Your Money Work for You." And if you listened to last night's Timing the Market section, I read the essay to you guys, and she just talked about when we feel is kind of the opportune time to kind of get back into the market. What she talks about is the trend recently changing, right? So the primary wave first turned up a couple of days ago. We haven't seen any green lights in the price column of the color guard yet. And she just talks about how to pay very close attention to the color guard. Will always let you guys know whether you're a prudent investor or an aggressive trader, when to start kind of dipping your toes back into the water here after a brutal August, wasn't it? But we're seeing some relief here over the last couple of days. We don't know what the next week is going to have in store for us, and she goes on to say that. We just have to continue to follow the color guard and listen to our guidance, and we'll let you know. We'll let you know when the trend is strengthening. And that'll really come with all of our market timing signals and the sequence of signals. And I did talk about this last night, where you'll get a green light in the price column of the color guard. That'll be next. That could be next Wednesday. We may even get a DEW up signal or a confirmed up call next week as well. And Angie talked about how the earliest I believe we can get it confirmed up is Thursday of next week. So pretty important week next week here in the US in terms of significant market timing signal changes. She then talks about trading options and how she likes to use put options as protection in falling markets. So, selling long positions, right? Selling stocks is a very personal decision, and we give you guys a lot of guidance and guidelines on how to do that. But, there are times where you may not want to sell a stock that maybe you've had in your portfolio for a very long time, even though the market's falling. Maybe we even enter into a confirmed down situation. You've had these stocks for a while; they pay good dividends. You don't want to sell them, and that's fine. That's definitely fine. But there needs to be kind of mechanisms put in place to help protect against falling prices, protective puts, covered calls, collar options. Those are some of the things that Angie talks about here in her essay. I would suggest those of you who didn't watch last night's Timing the Market section to go ahead and do that, or just read Angie's essay. She does such a great job. And Jim did this week's special presentation on just different portfolio management skills, and I would suggest that you guys watch that as soon as you can. Okay. Next, we'll talk about is Stan's essay, and I really enjoyed this one, Stan. By the way, he titled it "The Weekly Graph," and he talks about how or which graph is better to use, a daily graph or a weekly graph. He says that really depends on your strategy, your investment goals, what type of trader you are. One thing that I would say, Stan says day traders and swing traders will argue that they don't care about price history on a weekly graph. I disagree with that argument, honestly, because the very best professional traders use all time frames. They want those time frames to be in sync. So if we're looking at a momentum swing trade, I want the weekly trend to be up as well, right? So if the daily trend is up, if the weekly trend is up, that just increases my probability on a successful trade. And I would even argue, if you're a day trader, if the daily trend is up and the weekly trend is up, the likelihood that that day is going to wind up being a profitable day goes up, right? When you have the other time frames in line with your preferred time frame, if that makes sense. So great essay, and he also goes through the NPI and using the NPI on weekly graphs. We've done a lot of work with just using them on daily charts, which obviously they work very well. But just slowing things down a little bit, being able to stay in trades longer. I know a lot of times that's our goal. We want to stay in trades a little bit longer. Even a swing trader doesn't like the volatility that's going on in this market right now. We tend to get bounced out of trades a little quicker. Slowing things down, looking at a longer time frames, looking at weekly charts, they just allow us to stay in trades a little longer than we normally would in volatile environments, like we're in now, and we really have been for quite some time. You can go through this again. He just goes through some performance of a couple of stocks here in the Canadian market, and based on the NPI weekly setup. Okay. Mr. Glenn Tompkins, what a character. Love the man. Glenn does a great job with our Trending Thursdays, and we want to include this, part of the Trending Thursdays and part of a lot of our YouTube content. Glenn and Patrick do a great job in, trying to present stocks that might be flying under the radar. Sure, there might be some speculative plays. I think that's always okay with a portion of your portfolio, right? You don't want to throw your entire portfolio into these types of stocks. In this case, Glenn talks about Workhorse and the fact that they were in line to obtain a contract from the Postal Service to build new EVs for their delivery vehicles. That fell through, but just recently, the Postal Service decided to up their EV production, or their EV orders for their postal vehicles, and they might need Workhorse in the future to to come through with those EV vehicles. The company that, and I can't really see here, and you guys can read the paragraph here. We don't talk about the company that is yet to make an EV that actually got the contract from the Postal Service. I'm not sure what that company was, but it says here the company has yet to make an electric vehicle. So keep an eye on Workhorse. WKHS is the ticker. Put it in a watch list. Keep an eye on the news, which is very important. In fact, actually, I'll go to where's my news here? Let's see. Nope, doesn't look like I closed that window. But go to Yahoo Finance. Just right-click on the stock within the stock view, or if you have the stock in a watch list. A second here, guys. Sorry about that. Gotcha. Thank you, Joey. Put the stock in a watch list, right-click on it, go to the view the stock news, look at all the recent articles, and you'll find an article about what we're talking about here. Again, it's a speculative play, but just keep an eye on it. If they do happen to obtain that contract, the stock will probably, take off. So you want to be there when it does. So here are all the color guards, folks, in all 5 of our markets: Canada, US, Australia, UK, and EU. We'll start with the Vectorvest Canada. You could see a lot of yellow starting to appear in the color guard. The primary trend of the market, this is important for anybody out there in Canada who is a little bit more of an aggressive trader. Primary wave first turned up. Let me make sure you guys can see my cursor at all times. Give me a moment. There we go. Primary wave first turned up here for the first time in a while, right? It's been about 3 weeks since the short-term trend of the market is up. Sure, yellow lights across the board in the color guard, but it does look like all of our market timing indicators higher on a week-over-week basis. If we just look back 1, 2, 3, 4, 5 days ago, all of our market timing indicators higher week-over-week. We'll take a look at a market timing graph for each of the markets that we're looking at here. But again, this is just a very terse, quick snapshot of the status of our market timing indicators, really the trends of those indicators as well. Now, just to take note, the MTI is still below 1, so we're in an up-down situation in Canada. Primary trend is up, underlying trend is up. So what does that mean for you as the Canadian investor? If you're a little bit more aggressive, you might start to think about buying stocks on Monday if the market continues to rise, right? If you're a little bit more prudent, what are you waiting for? You're waiting for a green light potentially in the price column of the color guard. You're waiting for the MTI to cross above 1. Maybe you're waiting for a DEW up signal before entering back into the market. So very early stages here in Canada of a new uptrend. Be very careful. Dip your toes in with a position or two if you are a little bit more aggressive. But again, if you're a little bit more prudent or conservative, you're waiting for a more maybe reliable signal, like a green light in the price column of the color guard, like the GLB RT kicker, DEW, confirm calls. If the market keeps running, those are the signals that you'll see moving forward. Okay. If we move, by the way, the Vectorvest composite/CA is down about 14% year to date. I think that's an important metric, right? Because how are you doing year to date? Are you outperforming the market? Which anything less than you losing 14%, if you're losing 10%, if you're losing 5%, look, you're outperforming the market, not making money, but you're outperforming the market. We hope that's not the case. We hope, of course, that you are making money, and anything above positive territory is fantastic, with the overall market, again, falling about 14%. Vectorvest composite here in the US is down about 17%. We're seeing the same type of behavior here in terms of the market. Where in Canada we had a predominantly red color guard, and we're seeing that transition from a falling market to the very beginning stages of a rising market. We're seeing that here in the US as well. Let me pull up another thing here. Give me a second. Primary wave just recently turned up. Now today's Saturday, so the primary wave turned up on Thursday here in the US. The earliest we can get a green light in the price column of the color guard is Wednesday of next week. The earliest we can get a confirmed up call is Thursday of next week. Same situation. If you're an aggressive trader, you're starting to dip back in. In fact, in our swing trading coaching group, which myself, Steve Chappell, Stan Heller, Dr. David Paul, we facilitate every single Thursday. We did enter into a couple of long positions for the first time in a while just on Thursday. It was actually done Thursday right before our coaching session ended, close to 4 o'clock. It was a couple of RSI2 trades that we did pretty well. You know, yesterday was a great day in the market, so those trades winded up being profitable so far. But just to let you guys know, that's what we're doing in our swing trading coaching group portfolio. Jim will tell you that in his retirement portfolio, they're inactive, right? They're not ready to buy stocks yet. I believe Jim is using the confirm calls, you know, in one of his portfolios, or maybe even the DEW. Nevertheless, neither one of those signals are bullish right now. So it just depends on your perspective, your strategy. Going back to what Stan wrote in his essay about, the types of charts you should be looking at. And I would go as far as to say the type of market timing signals that you should be using all depends on your investment perspective and your objectives, right? So with the primary wave first turning up here for the last couple of days, the only traders or investors who are participating right now are the aggressive ones. Green light in the price column of the color guard, confirmed up call. That might come the next week if the market continues to run. If you're a little bit more prudent, now you're starting to step into the market. Okay. If we look forward over to Vectorvest Australia, the Vectorvest CA /AU is down 14% year to date. Now we do have a green light in the RT column here. The primary wave is up. That's kind of what I always look at. The primary wave is up. What is the trend, right? What's the short-term trend? What's the underlying trend? And are we in a confirmed up or a confirmed down? That's kind of where my eyes first move to. We are in a primary wave up, so the short-term trend is up, but the underlying trend is down, and we are still in a confirmed down. So who's taking advantage now of this market? Same thing. If you're a little bit more aggressive, you are. If you're prudent, you're not, right? If you're conservative, you're not yet. You know, when we see these transitions occur, from a bearish market to a bullish market, and when we recognize the very beginning stages of it, which is what's happening now with the transition from red to yellow in most of the markets that we're seeing, that is the very beginning stages of a new uptrend. The reversal has taken place. New uptrend has begun. That uptrend is still rather weak because it's just the market moving higher week over week, right? We're not getting the consistent or sustainable move just yet. That happens in a couple weeks. Market moves higher for 2 weeks, and the MTI goes above 1, buy to sell ratio goes above 1. Now we're in much more of a comfortable environment, and everybody's participating at that point. You're conservative, you're aggressive, everybody's starting to buy stocks once that happens. If we look forward to Vectorvest UK, down 12%, excuse me, Vectorvest VVC/UK down about 12% year to date. Now here we have a green light in the price column of the color guard. So primary wave is up for the second day. Underlying trend down, still in a confirmed down. MTI higher week over week. Buy to sell ratio higher week over week. RT higher week over week. Price of the VVC higher not only week over week, but day over day. So first primary wave up, that was Thursday. If you're aggressive, you're starting to re-enter long positions after being either short or in cash for the last month or so. Green light in the price column of the color guard. If you're more prudent, now you're starting to get in. MTI goes above 1. Hopefully that'll happen next week if the market continues to go higher. And now, again, underlying trend is up, much more comfortable environment for everybody to be trading in. And finally, the VVC/EU down about 15.5% year to date. 2 green lights in the color guard. Same situation where the primary wave is up for the second day, underlying trend down. We're still in a confirmed down. MTI, though, all of our indicators here also higher on a week over week basis. So across the board, guys, we are seeing a rally, right? With all of our markets here, the markets, 3-4 days or so, just depending on which market we're speaking about, is moving higher on a week over week basis. Let me move us quick before I get into the next slide here. Let me hop into the program, and I'm going to go through a couple of our market timing graphs because there were a few things in the US and Canada that I wanted to point out. If I go to graphs, this is my account, so I have a lot of lines drawn on this chart. But just looking at the hard right edge, here's the rally that we're speaking about. If I put on support and resistance, which is something that I always like to look at, here in the US, the Vectorvest composite on, let's see, it was Wednesday of this week, it was the 7th, formed a bullish engulfing pattern. That is a bullish reversal candlestick signal. It's one of the more reliable two-bar formations, I think. We did get confirmation of that bullish engulfing on Thursday. Got a nice retracement off of this 54.12 support zone. We have resistance up here at 58.27 that we have to pay attention to. But more importantly, the Vectorvest composite is forming, and over the last couple of days, it has really kind of played out, is forming what's called an inverse head and shoulders pattern. It is a bullish reversal signal. And it looks like this. Let me kind of draw my lines again. Over here, May, you had the left shoulder. You had a swing low, a lower swing low. The rally petered out right about here in the beginning of June, forming another, excuse me, lower swing high. The market winded up making new lows, kind of based there for a couple of weeks in July. Then really nice, strong rally there at the end of July. And that basing pattern there formed the head of what will complete the inverse head and shoulders pattern. The market rallied, and it actually did break through the previous swing high here. Not all that far away from it. And then the retreat occurred, right? The really significant sell-off last month caused the Vectorvest composite to almost retest the 52-week low. We didn't quite get there, but look at where the VVC stopped. I'm going to draw a horizontal line here so you guys can see it. Right at the same level that it stopped and rallied in May. The subsequent rally over the last 3 days is now forming the right shoulder of this inverse head and shoulders pattern. Again, it's a bullish reversal signal. Technically speaking, we need to see the market break above the neckline, excuse me, for a significant breakout and for any chance that, that we've seen the bottom and higher prices are ahead. That's not to say that you can't take advantage of this market up until that point, because look, we're looking at 59 and change as the neckline. We're at 56 and change now. So $3 on a $56 stock price. We're looking at the VVC. So we're looking at about, 6-7% upside here, market upside, which could translate into, higher returns, of course, on the stock level. But plenty of upside to the neckline. So when Angie says in her essay, she says, we don't know what next week has in store. We're going to follow the system. We're going to play the trend and follow the trend. And, here in the US, if I go back to the homepage, the short-term trend is up. I know the underlying trend is down because look, this is what we're looking at here is, the market timing graph put on the MTI. Underlying trend is down, but the indicator is approaching 1. If you're aggressive, you've already started to pick up shares, haven't you? Right? Again, we did that in our swing trading coaching group a couple of days ago. I know the Jockey Club guys here in the US are beginning to do that as well. We are all paying attention to the neckline. Any long position that anybody takes here moving forward has to be managed very carefully once the VVC approaches the neckline, because that is kind of the do or die area where, man, if we break above that, fantastic. I can even see the market retesting the $64 resistance zone, which was the previous neckline of the head and shoulders pattern that we saw back in January, February, March. Now that we didn't get the breakout, did we? Right. So here's the left shoulder. Here's the head. Here's the right shoulder. This neckline is horizontal. Sometimes the necklines can be crooked in an inverse head and shoulders as well as a head and shoulders pattern, which is what we saw back in September and November. There's your head and shoulders. That's a bearish reversal signal. There's your left shoulder, your head, your right shoulder, your neckline. So bearish, this one played out for sure, right? So your confirmation or your breakdown below the head and shoulders pattern was here in January, and then all bets were off at that point. We haven't seen prices that high in a while. We thought we saw an invert. We thought we were kind of encouraged to see the inverse head and shoulders pattern here. Never broke above the neckline and just continued to fall. We could see the same thing, guys. That's why it's very important to to make sure that the market does break above the neckline before getting too deep and before really starting to get invested, because this is a very reliable a bullish reversal signal. Same thing in the Canadian market. Let me find my Vectorvest Canada program. Let me pull that over. Go to my market timing graph here. Same thing, same type of pattern. Left shoulder, retreat, new lows, head. Here was almost a kind of a horizontal neckline as well, a little crooked, but again, the rally there petered out at almost the same level that it did in June. The retreat, the right shoulder forming at almost the same level that it formed back here. Guys, it doesn't have to always be symmetrical, and these pivot points aren't always in the same exact spot. Sometimes they could be a little crooked, but the behavior is the same. What does an inverse head and shoulders suggest? It suggests a weakening downtrend, okay? A weakening downtrend. This rally here, this swing low, whoops, for all intents and purposes, right, it's higher than the previous swing low. So we have we're slightly encouraged here that we can at least get to the neckline, and again, plenty upside till about $26 or so, another dollar or so from where the current market is at now. So very similar patterns here for both the U.S. And the Canadian markets. Here we're looking at top RT Delta industry groups. This is going to be a fun segment here because I'm going to go into the program. I'm going to show you guys how to build this little scan. You don't really have to build it actually because it's a canned default Vectorvest search. So if I go to Unisearch and let me clear the deck here. Let me open up our Delta Searches Industries folder, and what we were looking at there is a 10-day RT Delta on all of the industry groups that we currently track in the Vectorvest Canada program. And in the Vectorvest Canada program, we're currently tracking 122 industries, okay? So I'm going to run this little scan. Again, it's a one-line scan. Industry RT Delta. Basically, what we're looking for are the industries, and I'm only going to look at the top 10, the industry groups whose relative timing has gone up the most percentage-wise over the last 10 days. That's what this one-line search is giving us. Home furniture, transportation airlines, software healthcare, petroleum, internet service providers, internet e-commerce, and you could see these are the top 10 RT Delta industry groups. Home furniture, this industry group's RT has doubled, more than doubled in the last 10 days. Okay, so if we first look at an industry graph, I think that'll be helpful. Look at the industry graph. This is interesting. So the industry price, as you can see, in a downtrend here over the last month. Look at the RT indicator. Even though the price of the industry has been falling, the RT indicator has been rising. What's that called, guys? What's that called? That's called a bullish divergence. A bullish divergence. So really nice pop here with the industry group RT. I bet we could find some stocks in this industry group that are really moving. I know the industry itself, the industry as a whole, isn't performing the way we would kind of normally see price performing with the RT indicator accelerating like it is, but it's a little deceiving in just looking at the industry group price. I'm going to close this chart, and then what we can do is we can right-click on the industry, and we can view, let's view, what do we want to view? The stocks in the industry group. There are only 3. All right, so that makes a little sense. Let's look at the charts now of the stocks in that industry group. Take off support and resistance. Well, actually, let's keep a support and resistance on. Here with ZZZ, we're kind of hovering right at this. Looks like it's support at 26.49. A nice retracement off of that support level might be a nice might be a nice bullish trade, or a breakout above 27.79 might be a good entry there as well. But I hesitate buying a stock at support. I like to see at least that stock's price settle into that support level and retrace from it before I enter back in. This might be what's throwing off the industry group, guys. That's why it's so important to look at the not only the chart of the industry, but the stocks within that industry, because I could see that here with there are only 3 stocks in this industry. The RT of this stock has really exploded. Let's look at the one below it. Same thing here. So a little deceiving here. With that industry group. That's why, again, just look at the industry group and take a look at the stocks within that group. Let's look at transportation airlines. This industry's RT has gone up 41% over the last 10 days. We'll look at the industry graph. There you go. That's kind of what we're looking for, right? Nice rising RT. Industry group prices rising. Industry group has a resistance level at 1270. I think we could find some good stocks in this industry group. So what you would do, just right click on transportation airlines, view stocks in the industry group. Not many in here as well, but the big one, of course, Air Canada. Nice RT of 1.2. Fundamentals are poor, to say the least. It's overvalued. Relative value, relative safety are below 1, but the stock is in an uptrend. The RT indicator is at 1.20, and there you go. You got a stock here that's kind of in the early stages of a new uptrend. If you're a trader, even if you're an investor, I think you're kind of putting this one in a watch list, right? We're right at resistance or approaching 1925 resistance. You got another resistance level at 1995. How has the stock fared at those levels? Well, we don't know yet, because we're actually seeing one of the first or second retests of that zone. It was significant support all year, right? End of last year, January, March, April, May. It was significant support. When the price of the stock fell below support, it becomes resistance. That zone becomes resistance, and we're just starting to see retests of that resistance zone. And we saw it here in the middle of August, and we're in the middle of seeing it here now. So again, I would, if you're a trader or just looking maybe for a potential entry here, we're only giving it a hold right now. It's not a buy rating just yet. RT is above 1, which is good, but technically speaking, you're right at resistance. Just like I don't go long at support, I don't go long at resistance either. I wait for the stock price to break above resistance, because historically that zone tends to be an area where selling pressure overcomes buying pressure, and I don't want to get into a long position when that's the case. Okay. All right, let me close out of that. So we did that with the Vectorvest Canada. We can do the same thing, top RT Delta Industries in the US as well. Let me open up my US program. Okay, go to Unisearch, Delta Searches Industries, top RT, a 10-day RT Delta. We run it as of the close of Friday. I'm only going to return the top 10. And it's searching. So just Lee is saying, says, I agree, longer term is different. Looks like another dead cat bounce. I think that's kind of the overriding opinion on a lot of folks here, that we are just in the middle of a dead cat bounce. And look, you don't know that it's a dead cat bounce when it's happening. You know when the market sells off and retreats. So that's why not jumping in head first with 10 new positions in the early stages like we're seeing here is probably the smart thing to do. And just picking up a stock or two, having your stops in place. If it does wind up being a dead cat bounce, you're not overly exposed, and you're cutting your losses rather early. If it does wind up being in the beginning stages of a stronger rally, then you're continuing to add positions when you see that. Okay. So mining uranium, this is, again, a 10-day RT Delta. Mining uranium, 46% 10-day RT Delta. ETF short, 30%. So we're looking at the last 10 days here. So we're including the data. If I go back to the market timing graph, we're including a lot of this data here in the 10-day RT Delta. How about this? how about, just to kind of throw a little wrench, how about a 3-day RT delta? Why 3 days? Because that's how long the market has been rising for, right? We're only seeing a 3-day rally. Let's look at a 3-day RT delta. Which industry groups have kind of participated or benefited the most from the last 3 days? So you could just kind of dial that down. Instead of a 10-day RT delta, you can look at a 3-day RT delta. Petroleum, retail department stores, you could see the RT deltas here over the last 3 days. If I right click on petroleum, view the industry graph, put the RT on, there we go. Nice move here with relative timing. Petroleum just rallying off of a higher swing low, so it looks like a new uptrend here. Right, there was the low, higher low, another higher low, so we're kind of moving off of that trend line. So you can kind of take a look at some stocks within the industry groups here. Okay, let me hop back into the slides. Just another slide here. So top 10 gainers, global market and market sectors, both in the US. I'll show you guys how to build this scan as well. If I go back into the US platform, let's see. Okay. One more time. Sorry about that. 10-day price delta. Okay, so we're looking at stock price, 10-day price delta, and we're only looking at global market ETFs, and here they are. So if you're not sure exactly how to build that, let me show you guys quick. So instead of a 10-day RT delta, we're going to be actually looking at delta searches stocks, and we're going to be looking at a 10-day price delta, which is not here, but we can just select 200-day price delta and change it, right? Change it from a 200-day to a 10-day price delta. I'm also going to filter and use that global ETFs watch list. So to do that, you go to stocks, filter by watch list. That watch list equals, believe it or not, the global ETFs watch list is not in the ETFs folder. To my and Ray's surprise earlier today, it's actually in the cherry picking folder. So if I go to cherry picking, go to global market ETFs and run that search, you'll see the same 10 there that we saw on the slide. Now, what I like to do with ETFs, scroll over to the right, look at the volume. Look, you're not going to trade BKF. It trades 7,000 shares on average. I would even argue that you wouldn't trade ENZL either, 43,000 shares on average. You can sort the list by average volume if you wanted to, and then you'll see more of the more actively traded ones at the top. Look, even though I sorted by average volume, we're still looking at, you know, the industry group. I'm sorry, the stock prices that are up. Let me go back to here. Actually, no, that does change the sort. Let me rerun that scan. It does change the sort, and we want to keep the sort the same. Let me just say no here. This will be quick, guys. Sorry about that. I'm going to add a volume parameter to the scan. That was the point that I was trying to make, because you know, you scroll over to the left. You can cherry pick through the top of the list, and only select the ones with the higher average volume, or you can just add a volume parameter to it. So I go price volume, average volume. Let's say we want it greater than. Let's go 500,000 shares. With ETFs, I like some liquidity there. So we run the search, and here you go. All of the average volumes are greater than 500,000 shares, and I didn't change the sort. So now we're still looking at the ones that have gone up the most over the last 10 days. And this one, this Chile ETF and India ETF are the only ones that actually have gone up over the last 10 days. That have an average volume greater than 500,000 shares. So if I right click on those, view the graphs, there's the 10-day price delta. Looks like it's kind of retreating a little bit from where? From resistance. Maybe a head and shoulders pattern forming as well. Left shoulder, head, right shoulder maybe. So I'm not quite sure if this is a viable trade. Here with INDA, moving in the right direction. You could see the RT trending higher as well. Looks like an inverse head and shoulders pattern that's kind of playing out here and breaking out to the upside. So look at the charts. and just, kind of cherry pick. That's why maybe that global market ETFs watch list is in the cherry picking folder. Makes sense now, because you want to go through the charts and cherry pick some of the better ones. Okay, as opposed to with this type of scan, taking the top 10. Okay. So we already went through the market timing graph in the US and in Canada, but the strategy section in the US in the Vectorvest views on Friday, I'll just read it quick. It says, despite lingering interest in inflation rate woes, investors picked up stocks this week. It says the price of the VVC gained $1.55 per share, and the primary trend is up. Our other market timing indicators, BSR, RT, and MTI, also higher over the last 5 trading days. It says, nevertheless, we'll need to see the price of the VVC move higher for one more week to give a preliminary signal of a sustainable uptrend. And that can happen as early as Thursday. Why? Because this past Thursday was the first week that the market went up on a week-over-week basis, right? The primary wave first turned up on Thursday, which means that on Thursday, the price of the VVC was higher than it was a week ago. If we fast forward to next Thursday, that's the earliest we can get it confirmed up. Now, the Derby winners here is something that I want to emphasize. Excuse me. The 5-day Derby winners, these are the best 5 searches in the Derby, in our Vectorvest real-time Derby over the last 5 trading days. 4 of the 5 are bottom fishing searches. Okay. That makes sense, even though if I get back into the program, we really start to see bottom fishing searches perform well after the buy to sell ratio gets below 0.2 and the MTI goes below 0.6. But we can see that on September 6th here, both of those indicators almost got to below those levels. So the market was, oversold. We all felt that, right? At the beginning of September, BSR got to 0.28, MTI got to 0.64. Again, very close to their respective oversold levels. 0.20 on the buy to sell ratio, 0.60 on the MTI. And the market rallied the day after. September 7th was the big day, right? Bullish engulfing pattern, really strong rally. So just to show you guys how well those bottom fishing searches perform in these type of market environments, if I go to Unisearch and I had my date to September 7th. I'm sorry. I should have been looking at the current date when I was running those Delta searches. If I go to the searches bottom fishing folder, take a look at jailbreak from the day, from the close of the day where the market rallied on September 7th. The top 10 stock, whoops, wrong button. Top 10 stocks from that day up 26%. PIXI went from 11 to 34 in 3 days. That's a 207% gain. SDIG went up 18%. You had some really big winners in there in just a very short period of time. So those of you that do attend the Jockey Club every morning, you're probably familiar with a lot of these bottom fishing searches. The guys use it quite often. But just to give you guys an idea of what the market has been favoring here over the last 3 days, and going back to our slide there, it's been bottom fishing searches. They've been performing really well over the last couple of days. So if you are trading the U.S. market, take a look at some of those searches here next week. If again, the market just continues to rally. In the Canadian market, it's at gains in banking and healthcare shares helped the price of the VVC reverse course and move higher this week, gained 45 cents per share, and the primary wave is up. Our other market timing indicators, RT, BSI, also higher over the last 5 trading days. Boy, same commentary. We'll need to see the price of the VVC/CA move higher for one more week to give us a preliminary signal of a sustainable uptrend. If you're prudent, make sure the market continues to run next week. If you're aggressive, you're starting to play the market to the upside. And look at this, the Derby winners in Vectorvest Canada as well, mostly bottom fishing, bottoms up. S&P TSX completion, jailbreak, we're starting to see the same type of searches here performing well over the last couple of days. Let's see. I'm going to go ahead and guys and just kind of fast forward here. And here is again the AU Australia timing section. There's what the market timing graph looks like. We're just coming off of, over the last couple of days, 2 days. That's it. Hasn't been a 3-day rally like in the US and Canada. 2-day rally here. Market timing indicators, buy to sell ratio, excuse me, MTI still below 1, but the RT indicator is above 1. So that's nice to see. The market's in an underlying downtrend still, but again, short-term uptrend. Same thing with UK. All three of our market timing indicators, while they're moving higher over the last week or so, still below 1. Okay, so all those indicators are still considered unfavorable. Here we're looking at a 3-day rally. Looks like an inverse head and shoulders maybe here too in the UK, right? Here's your left shoulder. Boy, that was significant support back then, wasn't it? Significant support then. Broke down through that support level. Look at that. Look at where the congestion occurred, right? After the market kind of based there for about a month or so and rallied. Look at little congestion. I'm not saying it was a retreat off of that, what's now resistance, right? Because it was support, 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 still support. But when the market broke down through that support level, it becomes resistance. A little congestion there at the end of July before the market rallied, and we're now seeing a retest, guys. So what's happening here in the UK is we're seeing a retest of support and seemingly a retracement off of that level. Okay, same thing in the UK where we're starting to see the trend turn where the primary trend is up. We need to see the market here in the UK move higher on a week-over-week basis for one more week to give a preliminary signal of a sustainable uptrend. Same situation across the board. And here's our Europe market timing graph. Support, support, support. Market broke down through that support level. Look at the retest of it. Boy, right on the penny. Retested resistance, retreated, retested resistance again, retreated. That's actually a ascending triangle there that's forming where you have a level of resistance, but it looked like there were higher lows put in there. So that's a bullish reversal signal called an ascending triangle. Once price breaks above that resistance level, there's your breakout. There's your confirmation of the ascending triangle, and we got it. Little mini retest, which you'll tend to see if price. And here we're looking at the market, guys. The same goes for stock prices. Price of the market, price of a stock breaks above resistance. You'll likely see a retest at some point. Sometimes it's immediate. Sometimes it takes a little longer. A retest of that support zone. So we saw the retest of the support zone rally. Where do we find ourselves now? Basically right at support again. Okay. And then finally, a question we should ask ourselves every week: where are we in the emotional market cycle? Okay. In the Canadian market, where the MTI is at 0.83, it has been rising. So where's 0.83 here? Kind of right in this area here. We're not in the blast off phase. Well, I would say maybe we're still in the midst of the blast off phase. I would say the blast off phase, guys, ends when the MTI goes above 1. Then you're in the trending phase. So you know what? We are in the blast off phase here for both the US and the Canadian markets, where let's see, the buy to sell ratio, the MTI got, what did it get to? 0.64, I believe. So really close to that 0.6 level. And then we've seen a really strong rally over the last 3 days. MTI in Canada is at 0.83. In the US at 0.90, both still below 1. What does that mean? That means that the underlying trend is up. So yeah, I think we are still in the blast off phase here for both of these markets. MTI crosses above 1. Now you're in the trending phase. Okay, so we'll keep an eye on that next week. Hopefully that'll happen both in all markets, right? But here we're looking at the U.S. and Canada. All right. So thank you, guys. I'm gonna bring in Jim. I want to thank Ray and Stan, of course. Boy, that was a lot to cover there. I didn't have a chance to look at the questions all that much, but I do want to thank Ray and Stan for being there and answering. I'm going to turn things over to Jim. He's going to do a great presentation on the building blocks of options trading. Welcome aboard, Jim.
Hi, Jared. How you doing?
Good,
great job as always. Let me make sure. I'm going to share my screen here with everyone, and you guys let me know when there it goes, so I can see it now. All right. Well, there we go. Okay. Just getting through a little technical stuff here. Thank you so much, Jared. My name is Jim Penn. I'm the manager of retirement services here at Vectorvest. I'm very happy to be part of today's user group, and thank you all for being here. What I want to talk about today has a lot to do with all of that great information Jerry just shared. Now, I'm going to talk about an introduction to options trading. Many of you may be new to options here. Many of you may be, experienced option traders. Either way, the idea here is to help you find ways to better manage your portfolio, to build your portfolio. I'm looking at a lot of the comments and questions in the chat box. We have bulls out there, we have bears out there. There's a lot of what ifs, and the ability to understand options and trade options in this market on many levels is so important to building and managing your portfolio. So my purpose here is not only to give a foundation of option trading, but also apply it to this current market and why it's so important for you. So let's go ahead and just jump right in. Why trade options, right? A lot of folks, again, I know there's probably experienced option traders and folks who have never traded options. What if you could increase your leverage without paying margin rates, right? What if you didn't have to pay your broker to borrow money to get better leverage? What if you could profit from falling prices with limited risk, right? I often say that if I take my retirement services hat off for a minute, I could care less if the market is going up or down. As long as I can define a trend, which Vectorvest always allows me to do, I can make money whether the market's going up or down. So I'm able to, profit from falling prices, generating steady income in your account, getting paid to enter into long positions, in other words, selling puts. And most importantly to me, the ability to insure your positions, right? Or even your overall portfolio in the uncertainty that we see, right? I was laughing with Ray a little bit ago. I see a lot of bulls and bears in the market. I have my own opinions, but I'll always heed the color guard, and I'll make sure that I insure my portfolio when I feel the time is right and when Vectorvest tells me to. So if you could do all that, right, that would help you manage your portfolio if you're not already doing it. So a lot of what I talk about here in the options portion of this comes from the 7 Secrets of Making Money with Vectorvest. We know Dr. DeLito created and gave this presentation many times over the years. Always a powerful educational experience. I learn something new every time I watch it. But mostly what we focus on, or what I'm going to focus on here, is secret number 5, learn to trade options and why you should learn to trade options. Right, I'm going to do my best to lay a foundation for the option basics here. But mostly my goal here is to show you why, if you're not already, you should be at least learning to trade options to better manage your portfolio. So why trade options? I already talked about providing leverage. Right? The versatility and flexibility of options is endless. Right? Number 1 is provide leverage. You reduce risk because you have less capital outlay. Right? Again, the definition of leverage: lower costs. You can generate income, and it increases your alternatives in the market without going out and having to, push a lot of chips on the table to buy stocks. Instead of doing that, you can use the power of leverage to do that. But the key is they must be used properly, right? You can't, you got to have that foundation in place to be able to do it. So options are financial instruments that can provide you, the individual investor, with the flexibility you need in almost any investment situation. It used to be that, options were for, hedge fund managers and institutional investors. Those days are long gone. That's just not the way it is anymore. It's the individual investor who really needs the power of options, in my opinion, to be able to take care of their portfolios. So with that, I'm going to start and try to build a basic foundation for you on options trading. Okay, let me just make one quick comment. Okay, I know there's folks here from in Europe, UK, Australia, or wherever. The concepts I'm going to talk about are the same wherever you are. I know some markets are not as liquid, not always as easy to trade options. So that's going to depend on what market you're in. But where you can trade options, the concepts I'm going to talk about here relate to any market, because this really is just more of a theoretical. And then at the end, I'm going to show some examples of how you can apply the power of options. So an option, remember, is it's a contract, but it's a security. It trades just like a stock, bid price, ask price, market makers who are tasked with providing a fair and orderly market. So it trades just like an ETF or an underlying stock. So important to remember. It is a negotiated contract with strictly defined terms and conditions. And I'm going to talk about those terms and conditions in a moment. And here they are. Stock options provide the right, but not the obligation, to buy or sell units of 100 shares of a stock at a certain price by a certain date. Now, those are the strictly defined terms and conditions, certain price by a certain date. So that's the basic definition of what an options contract is. It's a contract and it's also a security. Now, the great way, or the best way that we found here at Vectorvest to kind of explain this to those who are new to options, right? There are only two types of options, calls and puts, right? Call options and put options. I'm going to define those in a moment. And there's only two things you can do with calls and puts, and that's buy or sell them, right? You could buy a call or sell a call. You can buy a put or sell a put. The most advanced option trades are all built on that foundation, and I'm not going to go into all of those obviously today, but let's talk about calls and puts. We'll define them. Call options provide the owner, the buyer of the call option, provides the owner the right to buy units of 100 shares of stock at a certain price by a certain date. In other words, from the origin of the name, right? You have the right to call away stock from someone else at a certain price by a certain date. Now, call options increase in value when the price of the underlying asset rises. And here's what that looks like. So on this, risk profile here that we have, the x-axis here being the price of the underlying stock, the y-axis being the value of the option. So if you're long or if you buy a call, the value of that underlying stock rises, well, so too does the value of your call option. Right, so your expectation is that the stock price will rise. Your risk, unlike owning a stock, which is the stock going to zero, here your risk is limited to whatever premium that you paid. And your reward, of course, is unlimited up until expiration date, because theoretically the stock could go to infinity and beyond. So that's the risk profile of a call. Let's talk about a put option real quick. Put options provide the owner the right to sell units of 100 shares, or it gives me the right to put that stock to someone else, to the seller of the put option. So it provides the owner the right to sell units of 100 shares at a certain price. Put options increase in value when the price of the underlying asset falls. So naturally, the call is a bearish trade when it rises, when the underlying asset rises. And so inherently a put option, being long a put option, is a bearish trade. Here's the risk reward profile again. Your expectation is that the stock will fall. Again, the x-axis is the price of the underlying stock. And so you can see the value of that put option rising. And again, your risk is limited to whatever premium, and I'm going to talk more about premiums in a minute, but whatever you pay for the option is what you do, is what you risk. The reward, parenthetically, is unlimited. We don't expect these stocks to go to zero, but whatever strike price you choose minus the premium paid, that's your max profit. Another way to illustrate that, I'm going to go through this quickly and just kind of reiterate, because I'm going to talk about the sellers. So far, I've talked about buying calls, buying puts. I'm not going to get too deep into selling calls and puts right now, but and in this little grid here that we have, right, calls and puts, buyers and sellers. As I said, that's all you can do with them. Buyer of a call has the right to buy 100 shares of a stock. Now, if you're the seller of a call, you're the seller of a call option here, right? You have the obligation to sell 100 shares of stock, right? So that would be a more bearish trade. Buyer of a put has the right to sell. We talked about that. And then finally, the seller of a put option has the obligation to buy shares of a stock at a certain price. So if we break that down, if I purchase a call option and I purchase the right to buy a stock, well, it means I better be bullish on the underlying market and on the underlying stock as well. If I sell a put option and obligate myself to buy a stock, well, then I also better be, bullish, because I may end up having to buy that stock. And then conversely, if you sell a call and you obligate yourself to sell a stock, or you buy the right to sell a stock, then you're looking at bearish trades. Now, one of the biggest benefits of understanding options and trading options is leverage. And I want to show a good illustration of leverage here for you. Margin accounts provide 2-to-1 leverage, and they increase both your risk and reward. Unless you're a pattern day trader, it may be 3 or 4 times, but either way, you're increasing both your risk and reward, which is fine if you're aware of that and do it properly. Options roughly provide a 10-to-1 leverage, and they can reduce risk when used properly. Common thing we talk about here, and I think Angie wrote about it in the essay, is that a lot of people think that options are risky and they're afraid of options, when in fact they were created as a measure of protection and to make things less risky. So very important to understand that idea. I'm going to share a quick example with you and try to illustrate the power of leverage. Okay. I'm sorry, I'm going to wait till I'm done here to try to answer questions. I'm looking at the chat box, but I'm going to finish first, and then I'll stay as long as you guys want to answer questions. So this is a theoretical example to illustrate the power of leverage. You're bullish on XYZ. It's trading at 129.73, and I'm going to compare this to owning a stock versus trading an option against it. Okay, so I'm bullish, or you're bullish on XYZ. It's trading at 129.73. You go out and you buy 100 shares. Right? Now, what happens? Well, you did good, right? Market was rising. You bought a good stock, and the stock went up to 139.79. Right? In just about a month, it's risen. That's a 7.7% increase. Fantastic. Now, let's take a look at the alternative. You're bullish on XYZ. It's trading at 129.73, but you want to buy the right to buy XYZ at 130. So what do? You go out, you buy a call option. Go out and you buy a call option. In this example, that call option, of course, gives you the right to buy 100 shares of XYZ at a certain price. In this case, we would buy the at the money, the 130 call option. And then we would have the right to do that by a certain date, which would be the expiration date. In this example, the call option happened to cost $3.65 per share for one contract, or $365 for the contract. That's the premium that you paid. What happened in this example? Well, a month later, as we saw, XYZ rose to 139.79, 7.7% increase on the stock. But let's take a look at what would have happened had you purchased the call options instead. We know that at 100 shares, 129.73 means it cost us $12,973. The value on March 1st was $13,979. That's $139.79 per share. Profit of $1,000, 7.7% gain, right? That's easy to understand for those who, for anyone who trades stocks. But your max risk is here at $12,973. The contract only costs $365. So that's your max risk. That's the most you could lose on this trade with no risk management techniques. The value of this call option on March 1st was $1,080. Now, the net profit was slightly below the 100 shares, but pretty close. But here's the key. Here's the definition of leverage, right? It was 195% return on that investment with a whole lot less risk. Now, I put in 3 contracts or 10 contracts. If you're new to options, when you're comfortable trading them, you still are putting out only a fraction of the amount it costs to buy the stocks. To control 300 shares cost me, I'll call it $1,100. The value was $32.40. That's $2,000 profit. Again, 195% return on the trade. These are the reasons understanding options and wanting to trade them is so important. So let's talk about some of the characteristics of options versus stocks and get a sense of the difference here. Well, first of all, again, leverage. Options generally cost about 10% of the price of the underlying stock. Not always, not exactly, but if you go a little bit further out for the expiration, maybe 6 months out to expiration, the options will generally cost about 10% of the price of the underlying stock. That's leverage, that's less capital you're risking. An example of leverage, as I just showed, a 5-point increase in an $80 stock would give you 6.25% gain. And a 5% increase in an $8 call option would give you 62.5% gain. Again, the power of leverage. There's lower risk, right? Options control a given number of shares of stock with substantially less investment exposure, as I just showed. Now, this is on long positions only, right? If you're short an option, that's a different story. But for when you're long a position, or you own a call, or you own a put, that risk is extremely low. Another characteristic to understand is that every option does have an expiration date. It is what we call a depleting asset. The value of that option depletes as it gets closer to expiration, right? The value declines. So an important factor to understand. One way to understand, an option trade is kind of an old school way we used to do it. I'm going to walk through, right? In the old days, I remember, so old I am, picking up the phone. You had to, maybe call your broker at a time, long time ago. And I want to buy to open one Apple November 155 call at 10:20 or better. These were roughly the prices yesterday. Okay, well, what does that mean? Let's walk through it. One Apple November 155 call at 10:20. First one, of course, is the contracts. We know one contract equals 100 shares. 10 contracts would be 1,000 shares. Next, the name, obviously, of the underlying company. In this case, it's Apple. The expiration date, or the duration. In this case, if I were buying today in September, our process would probably have me going out to at least a November expiration date. And I always use, for those who might ask, I always use the monthly expiration, by the way. Okay. So that's the expiration date. The 155 is the strike price of the option. This is the price at which we strike the deal. I have the right to buy 100 shares of Apple at 155. That's what I've negotiated here in my contract. Of course, the type of option, we know there's only two types. And then finally, the option premium. The price I'm willing to pay for the right to buy 100 shares of Apple at $155. So that's just a quick breakdown of the anatomy of an option trade. Right. Let's define a couple of these strictly defined terms and conditions. So the expiration date is the date which the owner of the option ceases to have the right to buy or sell the underlying stock. For monthly options, that is, there's two ways to look at it. The option ceases to trade at Friday at 4 p.m. Eastern time. But the actual option, expires on the Saturday following the third Friday of each month. That's for monthly options expiration. The strike price I talked about is the price at which the owner of a call option has the right to buy the underlying stock, or the owner of the put has the right to sell the underlying stock. You just negotiate this with the seller of the option. There are a lot of things that go into pricing options, and it's important to understand this too. This is where the difference between stocks and options come in. There's a lot of variables and things you have to understand so that you don't go out. One of the biggest mistakes a lot of folks new to options make is that they overpay, right? Or buy an overpriced option, which is a sure way to break your portfolio very early on in your options trading. So what do we look at? Well, not what we look at. I'll tell you it's the Black-Scholes pricing model. I'll talk a little bit about that in a moment. Stock price, the strike price, the duration, or in other words, the expiration date, the volatility of that underlying stock. I'll talk a little bit about that. And then to a lesser extent, the interest rates and dividends can play a part in the pricing of an option, but not as much as these first four factors come into play. So again, rule of thumb, at the money, option prices about 6 months out typically run about 10% of a stock's price when we're talking, again, about premium. So let's discuss option premium for a minute. It's the price that a buyer pays for an option. It's a price the buyer pays. So the price, there's two parts to that premium. There's intrinsic value and there's time value. These are terms that you will hear, or if you're familiar with options, you understand. But the intrinsic value, we'll talk about a call option here, is the stock price minus the strike price. Stock price minus the strike price. In other words, how in the money is that stock versus the strike price? So we know an in the money call option means that the stock price is greater than the strike price. So if ABC stock is trading at $55 a share and I have the right to buy it at $50 a share, that means I'm in the money. That's good for me. I have the right to buy it at 50. It's trading at 55. There would be $5 of intrinsic value to that option premium. An at the money option, whether it's a call or a put, means the stock price is equal to the strike price, give or take a couple of pennies here and there. And an out of the money option would mean, for a call option specifically, that the stock price is less than the strike price. So that same ABC stock, if I own the right to buy it at 55 and it's trading at 50, well, there's no intrinsic value because it's trading below my strike price. So here's just another grid to show you intrinsic value of calls. If the stock price is at 30, the strike price is at 30, then you're at the money. For a call option, if I'm long the 30 strike and the stock is at 35, well, I have $5 of intrinsic value and so on. You can see the flow of the chart here. All of these things become very important when you begin to set up your trades. So again, this is the foundation of how to do it. But the intrinsic value of a put is really just the mirror image. Strike price minus stock price would give me the intrinsic value. So if I buy a put option and I have the right to sell XYZ stock at $50 a share, and the stock is trading at $45 a share, well, then my intrinsic value is $5 per share, and it means I have an in-the-money put option. At the money, the same, and then again, out of the money would be strike greater than stock price. Again, all of these things are important when it comes to actually building and managing trades. And again, just the same grid showing similar information here. Now, I said there were two parts to an option premium. Now, the time value is the amount a buyer is willing to pay for an option above its intrinsic value. So time value equals premium minus the intrinsic value. So in other words, that same option I talked about earlier. ABC stock is trading at $55 a share. I own a call option at 50. I have a $5 intrinsic value. But if I were just setting up that trade and I go into my option chain and it tells me I have to pay $7 per share to own that option. The premium is $7 a share. There's $5 of intrinsic value, which would simply mean that the other $2 is what's called time value. And that's what makes up the option premium. It's intrinsic value or time value. If there's no intrinsic value, all you're doing is spending money on time value, and that's not the way ultimately that you want to trade your options. An important part of option trading is to understand time decay when it comes to, setting up your trade. What strike price, what expiration date do I use? In the Greeks, it's referred to as theta. Time decay is your enemy if you're long stocks. If you're long call options or put options. And as you can see here in this example, right, it's 180 days. The value of this option was at 70 cents. And you can see it takes 135 days to lose half the value of this option. Okay, this, all other things being equal, right? If the price stays right where it is, time decay on the option, it takes 135 days to lose that value. But as you see, it takes only 45 days to lose the last 50%. So time decay accelerates the closer you get to expiration. That's an important factor to understand when you're deciding what expiration date do I use to buy my option. Ultimately, you're going to want to give yourself more time than 30 to 45 days. Otherwise, time decay will deplete your asset even quicker. We talked about in pricing factor volatility was the next issue. Volatility, basic definition is measures the fluctuation of a stock's price movement in a given period, depending on what you're looking at, what you set it at. It's expressed in terms of annualized percentage change. That is the definition of historical volatility. That's historical volatility. When you're thinking of historical volatility versus implied volatility, understand historical volatility is what the underlying stock has done in the past, and implied volatility is what the market implies it might do in the future. So an important part of understanding whether you're overpaying or underpaying for an option is comparing implied vol to historical vol. Just a quick graph to try to explain it. So the price dispersion here, the wider it is, the higher the volatility, right? So this stock, the green line here would represent a stock that doesn't have a huge gap, of its high and low that the stock trades. This would be moderate, and this would be a stock that moves, in price. So this volatility would be much higher on this red line versus a stock that traded in a much narrower range. So that's just a quick illustration of that. I talked about Black-Scholes valuation model. It's a statistical model that calculates the theoretical value. Mr. Black-Scholes, there was another gentleman involved, actually won a Nobel Prize back in 1973, because up until this time, there was no way to value an option. It's whatever the traders used to literally on the floor just say, okay, this is what we'll agree to, without a way to actually value the options. Okay, now you can use it to determine the value of the option you're interested in. And I'll show a quick example before we're done. Right in the Vectorvest program, how you can go in and say, okay, am I overpaying for this option? Because if you are, well, don't. But it's a quick and easy way to determine if you are or if you're not. For your information, because I believe everyone's getting a copy of these slides here, it's just kind of a review of what happens to your call or put when these scenarios are occurring, right? Stock prices rise. On calls, your value of your call will rise, value of your put will fall. Okay. I won't go through each one. You guys can see. Well, we'll go through a couple of them. The further out you go for your expiration date, okay, what you're going to pay for your option increases. You're going to pay for that extra time. An option might look cheaper because there's less time. But remember, you get what you pay for. A low price, cheap option doesn't mean you're buying the right option. It's like a dividend stock. Right? Just because you see a high yield on a dividend stock doesn't make it the best candidate for your dividend portfolio. Well, same thing here. The best option trade is not the cheapest premium that you see. So that's just a good review of how the pricing factors work in there. We don't go too deeply into the Greeks in our basic options, courses in our study there. But the two that are important for the average individual option trader are delta and theta, right? Because these two will play a part in your actual option setup. So delta is the amount that an option's value changes per dollar of stock price change. And theta, again, is the amount that option value changes per unit in change of time. So time decay and delta. we'll take a minute and talk a little bit about delta. So again, the textbook definition is the amount a theoretical options price will change for a corresponding $1 change in the price of the underlying stock. In other words, ABC stock, let's say I own a 50 strike call, would be an at-the-money call option. The stock goes up $1. I paid $3 for the option. What happens? Again, not to the penny all the time, but what happens is that the price goes to $3.50. Right? That's a 50 delta. Stock goes to 52. What happens? The price goes from 350 to 410. That delta is rising. So that change in the option price for every dollar the stock moves, right? That's the textbook definition. And if you're long a call option, that's exactly what you want to see. Now, the non-textbook definition is that delta is the probability of the option being in the money at expiration date. So a 50 delta, if I buy a $50 call option on a stock that's trading right at 50, tells me there's a 50% chance that that stock closes a penny above or a penny below $50. It's a very important factor when again, building trades. We want deltas greater than 50. If delta is the probability of an option expiring, giving me a chance to make money, whether it's a put or a call, the whole idea behind options trading is to put probability in your favor. Put probability in your favor. Here's a great kind of grid here that we use. It is the premium versus the strike price and expiration. It's just a theoretical stock trading at 64 and change. I put yesterday's date down here to give you an indication of what how option pricing is so important in the importance of delta and understanding where to set your strike price and where to set your expiration date. So if the stock's trading at 64.78, I'm going to start here, right? We'll call it at the money. Okay. This is the premium. It would cost you roughly $1 to purchase this stock with a delta of 48. Now remember, you only got, a week to expiration. So first of all, I would never purchase that option anyway, but you'll see where the delta is right around 50. There's less than a 50-50 chance because of time. If I go out of the money, if I'm hoping that ABC stock goes from 64 to 64.78 to 67.5 at least, it's only going to cost me 24 cents a share, but this is what I'm talking about, right? Don't be fooled by that. Because now you only have a 17 delta. That's a 17% chance it's going to close at 67.50. And as you see, the further away that strike price is, the less you're paying, and that looks wonderful. But unless you've got some inside information, don't buy that one. Right? The call strike down at 60 is in the money, and so certainly it's going to cost you more. And the delta is all the way up at 97, because there's a really good chance that this stock is going to close above 60 in the next week or so. So you can kind of get a sense of how delta and premium work together. Our guidelines are basically, we want deltas greater than 50, maybe as high as 65. You don't have to go much higher than that. Some folks do like to, but at least 50 to 65. And I want to go at least 60 to 90 days out to expiration. So if I were doing this trade now, I would be looking probably at a November expiration and probably the 62.50 strike. Again, assuming my underlying bias on the overall market was bullish and on ABC stock was bullish. I have a 64 delta, 64% chance the stock closes above 62.5, and I would pay $4.28 for that option. So probably right in this range is where I would go. But this grid is a really good way just to understand, what you're looking for is enough time to be right, and putting probability in your favor, meaning a delta greater than 50 and at least 60 to 90 days out to expiration is really the best way to set up your trades. Now, that's a basic introduction to some of the terminology, to some of the information that you need to know before you begin to trade options. If you're new to options, listen, in this day and age, in this kind of market that Jerry just went through all of those conditions in the markets, is it a bear market rally? Is it the bottom, or, I don't know. None of us know, right? I always joke, I'm still waiting. I have a version of what we call here at Vectorvest. I'm not supposed to talk about it, but it's called Vectorvest End of Next Day. Vectorvest End of Next Day. So until that comes out, right, I'm going to have to listen to and heed the color guard, listen to Vectorvest and listen to Jerry when he gives his technical analysis. I love all that. Jerry, you do such a great job, but I'm mostly a support and resistance guy as a former market maker. It's where are the buyers, where are the sellers? That's all that really matters to me. But you remember, it's very hard in this market to go out and buy stocks, right? Because you've got to put a lot of chips on the table. You don't want to bottom fish. The beauty of options gives you that choice to be able to say, all right, I'm going to use the power of leverage. I'm going to see if this market continues to rise, I'll continue to go ahead and play this market to the upside, but I'll use the power of leverage. And if I'm wrong, I'm not going to get hurt too badly, right? It's all about position sizing and allocation, which is another whole hour-long talk on its own. I want to share just a quick idea, because one of the biggest things I'll put my retirement services hat back on. One of the biggest things or biggest reasons that you should understand options, if you're managing, right, your own net worth, your portfolio, you have to know how to protect it. Now, stop criteria is great. There's a lot of ways. No one is better than Vectorvest at helping you build and manage your portfolios. But if you're not using options to help protect yourself, you're missing out on a very valuable tool. This is from our Options Pro software. It's just kind of a look back at a trade. Now, in our retirement coaching group on the 23rd of August, we actually went in and created a simulated trade. Some are live money trades, some are simulated. But the MTI was like, I think, 1.68. Buy-sell ratio was hitting new highs, for recent highs. And I thought it was a great time to become defensive, not necessarily predicting a downtrend in the market or, this, whatever. I'm just using the information from Vectorvest to say, we're looking at potentially an overbought market, and I'm going to use options to protect my portfolio. So what I did was I went out, bought, in this case, and again, depending on the size of your portfolio, bought 5 option contracts, put options. When you're using for protection, you can use a little shorter term. It was the 412 strike, cost $8.94 per share, or about $4,500 to protect $100,000, $150,000, $200,000 portfolio, whatever the size of your portfolio might be. What happened? Well, you can see, I think this peaked during the sell-off at about $8,000 profit for these 5 contracts. I don't have the last couple of days on this screenshot that I took, but of course, the value of this, given the rally, would be going down. But again, with some risk management techniques in place, you would have made $3,000, $4,000, $5,000, maybe even more as a protected portfolio. We have specific risk management techniques that we use for these type of trades. So you would have probably been out somewhere around here, right? $3,000 or $4,000. That's profit. Could have taken that profit and reinvest it in another insurance policy on your portfolio. These are the great things about using options. And I'm looking at the time here. I'm going to start finishing up on the presentation part. I'll stay as long as they keep my microphone on to answer any questions that I can. If you go to Vectorvest University, okay, here's what I want you to do. Go to Vectorvest University. Oh, it's at university.vectorvest.com, and there is a free Options Foundation course there that you can click on. And it gives you a lot of what I just talked about, but of course, in a lot more detail. I think there's like 6 different modules to it. But go ahead and click there, and it'll bring you to the Options Foundation course. It's free. And it's found right there in the Vectorvest University. Okay, some really good stuff there as well. So that's, while I got 9 million other things I could add to all this and talk about, I'm going to kind of stop there and bring Jerry back and or see if there's any questions I can answer here. I haven't looked at the chat box, but
yeah.
If there's
Awesome,
anything that
Jim.
stands out, Jerry, let me know.
There's been a few guys. We're going to stick around for a few more minutes, so we'll do a quick Q&A here. There won't be a Q&A next week on today's session, but we'll do a quick Q&A here. Jim, I got a couple questions for you.
Okay.
Just bear with me here. So Erwin asks, Jim, what time duration would you recommend when substituting a call for purchasing a stock outright? The longer the better, or is there a practical maximum for optimizing profit potential? So how far out when buying a call?
Yeah, that's a great question. And what we do in our options course and in our retirement coaching group is we'll use a window of 60 to 90 days as a guideline. So if I'm buying a call option, I'm bearish on the market, I'm bearish on whatever, Apple, whatever it might be, I'm going to look at least 60 to 90 days out. It's a guideline. And by the way, I think I saw something about weekly. I personally only use monthly expirations. Rarely will I go and use a weekly. Sometimes I do, but mostly I don't. So 60 to 90 days is the guideline. So if I look up the monthly expiration and it's 56 days, that's fine. If it's 96 days or 98 days, that's fine.
If it's 26 days, no.
Exactly, right. It's a guideline, but don't stretch that guideline.
Yeah.
Keep it within reason, but 60 to 90 days gives you enough time to be right. And then just to add to that, we're always looking at a delta greater than 50. So in other words, I'm always looking at the very least an at the money strike price or a little deeper in the money. So somewhere between a 50 and 65 delta, 60 to 90 days out is a very general guidelines that we use.
Yep. And what about theta? Is there a theta? Because Imran was asking about real quick. He says, is there an optimal theta? Because he's experienced where, in the couple of weeks before expiration, even if the stock price rises, the option price falls. And I explained to him that theta has a lot to do with that. Time decay in the last 30 days, as you explained it earlier, affects the option price more so than it did earlier in the trade. Is there a theta optimal theta that you would recommend?
No, well, there's not a specific number, and there's a couple of reasons why what you just described happens to traders, and a lot of times it may not be just theta. So real quick, no, there's no specific theta number we look at. We kind of address that in the idea of the 60 to 90 days, right? That's going to usually give us that. That's why we go. That's why we don't say, I'm not going out and buy a weekly that expires, 2 weeks from now. Now, listen, can you do that? Of course you can, but for what we're doing, no. Now, the other reason, right? I talked a little bit about, again, I could do a whole session on implied volatility, historical volatility, but one reason why your option may go down even when the underlying stock goes up is because you overpaid for that option and you bought it at the wrong time. Because if you overpay, if implied volatility is much greater than historical volatility and you overpay for that option, there's a really good chance that even if the stock goes the way you want it to, there's a good chance the value of your option will deplete anyway. So theta may be playing a part, but overpaying for an option is one reason. I don't know if I have time. I'd love to go into the options pricing model and give an example, but you want to be careful that you don't overpay for an option. It is the single most hurtful mistake that any option trader can make is overpaying for an option when you're going long a call or a put.
Okay, so along those lines, question is, I have a tendency to buy puts when the option premium is overpriced, quote, in parentheses, fear in the market, fear that the market is high, overpaying for the insurance. How can I avoid that mistake?
Yeah,
really.
Also a great question. Now, oftentimes what I use for insurance, as I just showed, I showed that SPY trade. I'll often use the Qs or the diamonds, which tracks the Dow, IWM, which is the Russell. Those are usually the indexes that I stick to. And if I'm switching gears here now. If you're talking about protecting your portfolio, as I showed on the SPY, if you're overpaying a touch, and quite frankly, the SPY isn't always as overpriced as you think it might be, the Qs, but if you're using it as insurance, then sometimes we do have to go in and overpay a little bit. Okay. And I don't have time to do it now. Or you can do a spread, right? You can do, I don't think I have it open, but you can do a bear put spread where you can lower the cost of your insurance, right? There are trades to be able to do it. I don't have it up, but
You like collars? I know you could sell a higher call,
collars,
offset it a little bit.
Collars are another great way to go out and protect your portfolio or individual positions, I should say. So let's say I own Apple. The MTI is high. We're looking at perhaps an overbought market. I'm just creating a scenario here. So what could I do? Well, I could just buy a put option, buy an insurance policy on Apple. Let's say Apple's trading. I don't even know where it's trading. Let's just say it's trading at 155. Right? I could go out and sell a call option, a 160 strike, or even higher maybe. Take the premium I receive for selling the call option and put it towards buying my insurance of the put option, right? So I can do that. And so we have the ability to do that as well. So collar trades are also great trades.
Yep.
All right.
All right. Let's see. Okay. Last question. Oh, no, I'm sorry. That's not a question. It's just a comment. All right, guys. Well, thank you, Jim. I want to thank everybody, guys, for being here Saturday morning. Awesome for taking time out of your day, kind of giving you guys an update and head start on next week. Everybody's prepared for next week, right? We all know what we need to see in terms of our market signals, what the market needs to do Monday, Tuesday of next week. I hope what I went through initially, where I really spoke to the different type of investor out there. You guys know who you are. If you're an aggressive trader, you know what you're doing now. If you're more of a prudent or conservative investor, you know what you're doing now. You're waiting for more of a sustained trend that can happen next week across the board. I think with all of our markets, confirmed up call. If you're more conservative, you're then beginning to participate. So everybody's prepared for next week. All right. Awesome, guys. Well, thank you guys so much. I want to thank Jim, Stan, Ray for being here, Joey for producing our session today. So hopefully you guys have a great weekend, and we'll see everybody again soon. Take care, everybody.